Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Friday, June 11th, 2021. We'll start out with the broad markets. We'll do a quick update on the S&P 500, the sectors within the S&P 500, not just financials and industrials, which I'll hit on, but the rest of them, and then maybe a few other miscellaneous things that I've covered lately. Don't plan this to be a very long video, but I do want to go over the different sectors here. And of course, looking at the S&P 500 itself, I've been focused lately, putting a lot of eyes on the industrials and financials, as well as tech sector, but there's other sectors out there. But here's my S&P. This is a clean version of the chart, and there's our primary trend line off the lows. This is an alternative, or what I would call a BOD trend line, and I've added one to my chart of XLF. Thank you for Scott on the site. Remember, Scott posted a chart, identified an alternative trend line, and it's comparable to this one. That's why I wanted to bring it up. We have a similar trend line there. And same story. We have the divergence building, some pretty big divergences building on the S&P 500. So we'll see if they played out as they did back here when we had a divergent high. Let's roll over into the sectors now. Let's just do that real quick. XLK. All right, so the story on XLK is the tech sector, which is by far, without even a close second, by far the largest sector in the S&P 500, makes up a quarter of the S&P, a quarter of the returns out of the 11 different sectors there. So it shows you how big it is, how important it is. Put in a divergent high here, and that's still our high. That's back in April. And, kind of, it's not going down. It's still in an uptrend by all means, but kind of underperforming lately, especially compared to the financials and industrials. So as I talked about, anything can happen, but one of potential scenario would be a bullish scenario is if at the very least I see underperformance in the financials and industrials, and quite likely I see a decent correction as I've laid out case. But if that happens, if we see money coming out of financials and industrials and then moving back into tech, and a lot of those tech stocks that like Apple, Microsoft, Amazon that have stalled out for many months now, this doesn't show the whole picture. A lot of those big market leaders have been moving sideways. But if they start to pick up the baton and take off, then hey, that's healthy sector rotation. And because of that big weighting, you could see the financials correct and industrials correct, and still see the market either hold up or even go up while those are correcting, if tech can go up. So that's what it's all about, and that's how it looks. So let me just move on before I do. Okay, this is the BOD, or the secondary trend line. This was our primary trend line off the March lows. It was broken here, and we pushed up, made a marginal new high, but that new high was a divergent high. And because of this is a large part, but not the only part, the only reason that I'm not looking for another big run up in the market. At best, maybe another marginal new high, because it'll still be a divergent high if we have it anytime soon, and then a decent correction coming. We could may not even make that marginal new high. We'll see. We'll watch it. And that's again why I'm doing this video. These charts are dynamic. They change every day, and so we have to adjust and adapt. All right, XLV, healthcare sector. This is the current trend line. It was broken right here recently. Came down. I modified some levels here today on this chart. We have support around 121 now. Pretty good support. You can see a lot of reactions over the past couple months there. So that's a big level to watch. And in fact, I'm going to set a price alert now. I'm going to pull it down there to a little below 120.98. I'm going to set a price alert. That's not how I do it. I right click and then set alert, just to get a heads up if and when the a healthcare sector break. So we do have divergence. You can see the divergence down here. That divergence may or may not pan out. Now I'll also say this: we have the PPO signal line, the white line here on the PPO. It's a great trend indicator on a lot of securities, and basically it's bullish when it's above that zero line right there, the dotted line, dash line that I just circled, and you're in a bearish trend when below. So works pretty well, and so I have to give it that. I'd be remiss not to point out there's any chart. I can look at just about any chart and point out bullish or bearish things, and sometimes if there's too much conflicting evidence, then just stand back. And that's why really I've not been talking about this sector much, but I did want to point that out. So bulls want to see a turn up here, successful test at the zero line, and they also want to see us pop new highs and eventually take out these divergences. And sure, by the time that happens, we'll be up quite a bit, but it'll be longer term bullish. Up until and unless that happens, divergences more often than not result in corrections, just like we had a divergent high right here. and a correction, pretty good correction there, and expecting the same right here. But again, there's your level. Got to take out 121. If so, should be a quick run down to that first target there, about 117.66, and then any of these possibly all the way down there to about that 109.60 level. But again, the takeaway is we're looking at all the sectors. We're also, you can see the weightings. I think you can see it here. I have to update these time to time. They change a little, but it's about 16%, a little less than 16% weighting for the healthcare sector in the S&P 500. Next up is the financials at 10.6. So you see those two. Remember, XLK was over 25. The second largest sector, healthcare, is about 16, a little under 16, and then financials at 10. So these two combined only equal the largest one out there, tech. So and then you have oh yeah, I wanted to cover this, XLF. All right, so here's the that benefit of the doubt trend line. This is my primary trend line, comes off the October lows in XLF. That was broken the other day, as I've covered quite a bit recently. Nothing but red sticks so far. Today is a flattish day. You know, it's green. We're green right now, but you've got to really zoom in. You can see that little doji type candle. We've hardly gone anywhere. Today's just a consolidation day. You know, nothing goes down forever. Plus, and I'll get to that in a second. No, we're going to stay on task here. We're on the financials. I'll get to the other sectors in a second. Let me just show you something else to watch. So here's that BOD, or secondary benefit of the doubt trend line on XLF right there. And you know, this one supersedes it because it's longer. And it has more reactions on it, the big primary trend line I have, but this one certainly is valid enough. You have a cluster of reactions there, a cluster of reactions there, and then now, as of today, a reaction. We fell to it yesterday, stopped there, and then we're trading on it today. So that gives us a third and confirming reaction. And so level to watch. You know, what does that mean? Well, if we hold it, we back test. Well, if you back test, rally up and back test to the trend line, that would be an objective short entry, a back test. Or if we break this trend line, that should open a door for a move down to my first target there around 35, 33 or so. So that's what we're looking at on XLF. Now, I always talk about my check marks. These are lines I've had here for a while. I know there's a lot on the chart. I'll just draw over the most salient technical levels, which in this case is this trend line on JP Morgan right there, JPM, and we're right on it. So guess what? We don't have a check mark on JP Morgan. It's an empty box, or no check yet. In other words, we're right at support. And then if we take the trend line out, you got to give it a BOD line there, BOD level, benefit of the doubt at 157, because that is very big support. Look at all these reactions right here. Boom, 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 including that little failed breakout. See that little whipsaw right there, that doji stick? And then couldn't do it. You know, multiple attempts. Finally, boom, breakout, big green candles, back test, and we moved up. So this is a big level. In fact, I am going to set a price alert there as well. And so I believe there'll be a day in the near future where I'm going to get alerts going off like popcorn, because what happens when the sector finally, you know, a few more of these bigger stocks break down, I think we'll start to see really impulsive selling. We had a pretty good down day yesterday in XLF and a lot of the financials, especially the regional banks, which I highlighted as being even more bearish. If you want most bang for your buck, I already did a video covering the regional banks. They were down big, over 1% yesterday. But that's the level we need on JP Morgan. So again, no check mark there. That's the largest financial. Second largest by market cap is Bank of America, and we do have a check mark. We had a breakdown on Wednesday, big impulsive follow-through candle yesterday, which is absolutely a check mark in my book. But again, so far, the number one, the largest stock, JP Morgan, didn't break down. That's, of all of them, that's the one you really want to see go. So we have a check mark on number two. That's a clear sell signal. I don't have the next support I have is all the way down here at 40.39. So it's a clear, you know, sell signal to me. Hey, maybe it doesn't pan out, but you know, it's right as of now. I'd say that's a high probability short, and the odds will go up considerably if and when JP Morgan breaks support and XLF breaks that secondary trend line that I showed you a minute ago. Berkshire, no sell signals yet. This is the primary trend line right here. I know there's a lot on the chart. That's the trend line. So again, now we're 1 out of 3 so far on the top 3 with a check mark. And again, it's simple stuff. The more check marks you get, the more likely we are to get a considerably larger correction in the financials. Correction being defined as a drop of 10% or more. Wells Fargo, right above the benefit of the doubt trend line right there. Although this was my primary trend line, and that broke down. So we had a sell signal and a break of the primary trend line. We're coming up on the secondary trend line there, and then 49.53. So the way it works, check mark. If there was already a check mark there on the break of the primary trend line, secondary check mark will come if we break this secondary trend line, and we'll have a third check mark if we get a solid break, especially close below 43.59. Should open the door for a drop all the way down here to at least about that 38-ish support right there. So I'm going to give it kind of a questionable check mark. You get one there. Let's just give it a check mark. We'll call it that because we broke the primary trend line. MS, Morgan Stanley. No, I know there's a lot of lines here, but this is my primary trend line right there, and so no check mark yet. This is a big rising wedge, bearish rising wedge. Divergence line needs to be moved to right there, and so that one has yet to break down. So I could do this, and I won't. I could go through them all. I'll probably cover one or two more. Citibank and Schwab are up next, but I want to show you something. When you see all these, see how I have a series of trend lines here? That one was broken, a little minor trend line, gave a minor correction. Then I set up a secondary trend line there and it was broken, a bigger correction, and then an even bigger trend line and a correction. This correction was actually about equal in the drop in price, but it was longer in time. So you had again, I always say stocks can correct in one of two ways or a combination thereof, in price and or time, and that did that. And then my final trend line. And when I see a series of trend lines in this spacing, it reminds me of something, and that's Fibonacci fan lines. These are Fibonacci fan lines. You drag them. My icons, my drawing tools are to the right of this the screenshot here. You can't see them, but you put them at the lows, and that's what I've done here. And see how perfect they autofill. You just put them at the low point, and so there's the first fib fan line. Look at that, and that was at support level broken. And then the secondary fib fan line, you can see we hit it, danced on it, and then when we broke it, boom, we fall to the next one. That's usually how these work. When you break a fib fan line, you fall to the next one. They act as support and resistance. And here you hit it, you rode on it for a while, it acted as support, and then boom, you broke it. And what happened since? We've been back testing it from below. So ultimately, I'd expect to move down to the next fib fan line. You can also play around with these. For example, if I move it up here to that very short term, that was that shortest term trend line I had, there's that first correction, and you can see again, look how well prices danced off the second. They break the first fib fan line, they dance on the next one. Break that, you had impulsive leg down, actually cut right through that one. Again, you can play around with them on your chart, but there you can draw manual trend lines like I had before on this one here, or those fib fan lines. Either way, that is I think an important level right there. And then that purple line is an even longer term trend line. It's not a fib fan. I just had that one colored. Those fib fan lines were purple only by coincidence. But there's a primary trend line, which is a target, by the way. Again, it's a series of smaller, and they get bigger and bigger and bigger. And then finally, of course, if we break that primary trend line, that's going to open the door for an even much larger drop. Right now, what I see and what I think will happen is when we get a sell signal, which will be a break of this trend line, might as well set an alert there too. If I don't have it, I might already have it. I don't know. It can't hurt to have two. Break of that trend line is going to bring us down to the primary trend line and or that 76-ish level. They come in around together right now, so it depends if and when we get there, how long it takes to get there, which one will, this one comes in first right now, but they're very close. All right, that's it. I told you I'd look at two more. Citibank, and Citibank's a big one. That's why in the financials you've got a lot of big ones. Citibank, absolutely a check mark all day long. That is a nice clean trend line right there. And again, remember, smaller trend line right here, negative divergence, little rising wedge, breakdown, there's your sell signal, correction. Pushed up, had another nice clean up trend line. Correction here was mostly in time, more so than price. And now an even bigger trend line, and therefore I expect an even bigger drop. We have our sell signal. I think you can make it out here. It's very clear, nothing but red sticks since the breakdown earlier this week on Tuesday. And I don't see anything, really hardly any support, a little bit, but hardly anything down until that 73.39 level. And remember, sometimes you break down and back test, and sometimes you back test again, and then the big drop, and sometimes you break down and that's it. There's really no way of knowing whether you're going to have a back test or not. Some things can be your guide, but generally speaking, I just want to point out we have, so what, about almost half the components so far that I've covered have check marks, the other half don't. And then finally, Schwab, we'll leave it here. This is still a good sized company, 137 billion. And there's our primary uptrend line. Nice, clean, rising wedge pattern, negative divergence like everything else. And we broke down, we're back testing from below. First target and support still about $69, and I'd expect a reaction there on the initial tag and then a drop to about 61.60 or so. Okay, so that's the financials. Like I said, some work done and a little more work to go to really, give me a very high degree of confidence that we're going much lower. Otherwise, sometimes you get a few break down and a few hold up, and the trend continues. And if nothing else, this market has had extreme resiliency now for months because it's got the easiest Fed in history supporting it. So, not to mention the federal government as well. It's crazy, those airline bailouts and all that. I'll get to the airline stocks later. There are a lot of those I think have run their course for the rally. But there's another example: billions of dollars of free money grants given out to them, and when they didn't need it, government should have bought those shares like the automakers, and instead of just giving them the grants. But anyways, that's neither here nor there. Point being that the government has supported many industries and this market. So in addition to the Fed. XLC Communications, again, we probably won't go through each and every sector here, just a couple more because they're the higher weighted sectors. This one's a little over 10%. And this is really two stocks. It's Facebook and Alphabet. Those two collectively make up, at least as of June 15th, June of last year, again, I haven't updated in a little while, they made up 44% of this sector, this ETF. So really, you can just watch those two stocks. And then again, this is 10.6% of the S&P 500, and broke down my primary trend line right there recently, breakdown back test, and this purple line right here is my BOD or secondary trend line, and it's not as well defined, but that's it right there, and we're above that. So the divergences again tell me that it's only a matter of time before we have a decent correction. And again, the bigger the divergences get, typically the bigger the ensuing trend change is once it finally sets in. XLY, we had a trend line here that was broken. We had one here that was broken. This one was broken back tested. And the secondary trend line was broken. We fell down here. And I've recently added another trend line because I think there's enough reactions from this point and right here. So that should, break of that trend line should open a open the door for a move down to that's 156.25, give or take right there. That is my target on XLY. And we can either keep those old divergences. They are still going, they're still extending, but more recently the divergences are becoming more steep. The indicators are making much lower high. Oh no, take that back. We have to make a new high. And if we do, I wasn't looking up at the top. We have to equal or take out that previous high to keep these divergences intact and extended. So there's your levels. All right, let's move on. By the way, this is a 10.26% weighting with about 21% in Amazon. And again, this is old. That was as of March 8th. I last updated this. 21.35% in Amazon, 12.82 in Tesla. Oh, well, I'm not going to stop there because one more sector, of course, the industrials. And that was one I wanted to see break down with the financials. There's our trend line right there. Primary trend line. I think it's clean enough to be pretty valid. And recent breakdown. And we're well below the trend line now. And I don't see any support coming in really until we have the 50-day moving average just above this 101.37 first target, first support. Okay, under today's earlier post, there were a couple questions and comments, and I've replied to. I'll try to get to the other comments from last previous posts as soon as possible. But one of them was there was that secondary trend line from Scott that Becky posted. Scott had first posted that chart. Becky asked about this euro US dollar. I'm just going to defer you to this if you want to read about it, my thoughts on the dollar and the euro, both long term and near term, obviously, and I'll jump into it now. I've been near term bullish on the dollar and longer term bearish. I've been longer term bearish on the dollar for quite a while now, and still am. This is the DX, the dollar futures, and right now you can see, look what we did. We came up right to that previous reaction high there, and I'm still favoring a move up to these two targets. Next first stop 90.80, and probably get a reaction there, and then a move up here to at least that target. At this point in time, that's my final and preferred target. Doesn't mean we can't go higher, so I'm still looking just for a little more upside in the dollar. That would equate to more downside in the euro. But then longer term, again, as it's in that chart, I just posted, or I made comments, and I'll show you. Here's the euro US dollar. And where this is all going, you might give two squats about what the dollar or the euro is doing. But if you are trading gold or even commodities, which tend to be dollar sensitive, then you should be interested in following where the dollar and gold and the euro going, even if you're not going to trade them. I always use the euro and the dollar charts to help confirm or refute my analysis on gold, because gold, very much so, is a dollar sensitive asset, tends to move inversely to the dollar, meaning positively correlated with the euro. So there's our long-term primary downtrend line. This is a weekly chart, and so this was very bullish when we broke out above the weekly chart, and then we made a successful back test. But most recently we hit resistance. It wasn't just this previous reaction high right here. We also had nice support right there. That was a level. There was a reaction there. When we broke that support level, we had a waterfall sell-off. That helps to validate it. So that level is, give or take, I could move it a little higher. It's probably closer to about 1226, 1227 on the euro US dollar pair. And so what I said is, I expect, because I'm still expecting a little more downside in the euro, a little more upside in the dollar, that could bring us back to this 119, about 119.4 level there on the euro US dollar. I mean, again, a little more upside in the dollar, a little more downside in the euro, quite possibly, hard to say, and then move up. We've already checked this level a couple times, so I think we'd break out the next time we run up there, and then run up here to 126. So remember, if this happens, so if I'm right, no guarantees again, then we're going to see probably a little more weakness or pressure on gold. Gold may trade sideways. It could go down. I gave you a trend line earlier today, and I'll show you it again. If we break that, we're probably going to go a little lower. But then longer term, once those levels hit, if we do reverse and we do this, that's going to be net bullish for gold, and that would coincide with the next leg up for gold. Because remember, gold is going to be positively correlated with this chart, because this is the euro versus the dollar. So this is really what it's what the euro's doing. When this chart's going up, euro's going up and the dollar's falling. All right, and then look, Becky had brought out the point, hey, so there's divergence here. This was a slightly lower low than this previous high, slightly lower high, I'm sorry. So it's technically not, but it's close enough when they're there. So you can say there's some divergence there on the dollar. And if it plays out, yeah, it could play out, as I said, for another back test. That would be a pretty big drop in the euro and a pretty big rally in the dollar if that's the case. It's not my preferred scenario. I see one thing I pointed out in that post is, here's that good old tried and true PPO trend indicator. There's your zero line right here. When you are I like to use a signal line. It's the last of the two to cross. Told me the trend was bearish here, and it was. Told me right here you crossed over and there was a bullish trend, and that was a nice rally in the euro US dollar pair. Crossed down below here, bearish crossover. It said get out, the trend's bearish. And then right here, about a year ago this month, almost today, we crossed back above, and it has been, as you can see, and I zoom in nice and tight, has been and remains bullish. So and that, since the primary trend right now in the euro is bullish, you got to give favor or preference, or at least I am, to the overall trend, and that's why I think any pullback will be minor and bought up. Now, if we cross over here and we cross down below and we break the 119.360 support, if we go down to and below it, yeah, that's going to be bearish, and at the very least probably bring us back for another back test of the trend line, and maybe even worse. These trend changes tend to go for many months or even years when you get them using on this. Again, this is a weekly chart, not the daily. Okay, and then GC, Once in a while, if I see a clear thing on the GLD chart, I will update it. But just keep in mind this is gold futures, and gold's going to do GLD is going to do what the futures do. I just have more reactions. This is trading almost around the clock, so you have a lot more candles, and therefore you can pick up support and resistance levels that may not show on GLD, which only trades from 9:30 a.m. On the regular charting platform, of course. Regular trading hours 9:30 to 4 p.m. where gold of course is trading around the world, and gold is just as popular in other countries as it is here, in some cases more popular in countries like India. So in other words, whereas certain American companies really trade mainly on the US exchanges, gold is a worldwide asset, and therefore that's why I like to use futures. But boom, there it is. Divergent high. I warned of a likely correction in gold here, and so far that's what it's been. A correction mostly in time in price. I also said I was more apt, not crazy. You can certainly take a short trade on gold, make some money. So there's nothing against it, but it's in a bull trend, so I'm not expecting a huge drop. However, we are now at that trend line I've been pointing out, and again this morning. So this is do or die time. You typically in a bull trend, you buy pullbacks to support, especially primary trend line. Lately, that's been working, but you can see we're losing momentum. And there's a good chance, especially if I'm right on the dollar, where the dollar is going, then gold's going to break down. And we just had this small little divergent high right here put in. And so I'm favoring a break. I think we'll probably break down again, especially if my US dollar scenario plays out. And you have intersecting support, 1876.62-ish right there, right? That support line. And the primary uptrend line, again, primary on the 60-minute time frame, not on the daily or weekly, just on this time frame. So we're just going back to late March. There's your date scaling down here, late March, early April. That's it. Oh, and where do we go if we break? 1848 roughly. That's my first target, and potentially if things get ugly, we could come all the way back down here to 1802. So those are potential buying points, and for active traders, whether you want to short, whether you want to wait and go long and reverse on a bounce, or do both, short and then go long, whatever you want. That's my outlook on gold. And then silver, gosh, I haven't pulled that chart in a while. Let me just take a look at silver for you. Silver at resistance right now, 28,347 right there. We've spiked through it a few times here and here, but we've also had enough reactions on it, I believe, to make it valid. And if gold breaks that trend line, I give it very high odds that silver is going to come back, pull back to at least this 27,240 level, and quite possibly 2680. So those are your downside targets for silver. If you want to take a shot at a short, maybe a stop somewhat above there, targeting any or all of those levels right now. Again, we'll see where we go. 2680 would be the second and current pullback target, final target at this time. When I say current, because if things change and I see something else in the chart, so we may get more than that. Okay, and I updated a lot of the recently highlighted trade ideas this morning with those static chart images that I posted. So I'm just going to update this one because nothing's moving as far as individual stocks that I'm tracking. Nothing is moving more in percentage terms than this one lately. You can just swing trade this, even day trade it almost. You had that was a level I highlighted a few days ago. Well, first of all, I highlighted this triangle. Somebody said the next break of that triangle up or down would most likely determine the next tradable trend, and it favored the downside break, and that's what we had right there. And as I mentioned earlier today, what was that from the breakdown point? It was roughly into yesterday's lows, or was it Thursday's low? Thursday, yeah, yesterday's low was about a 28% drop. 41.23 is support. You can see right here reactions. There are some reactions, and that reaction. So that's a level. And as I said this morning, had some arrows. We're getting close. I said it's an objective short up to that 48.25 and or downtrend line. Those are big resistance levels above. So right now, as I'm doing the video, very much an objective short entry. However, you short it now as a swing trade, even a day trade. I don't expect anything big to happen before the close. You're going to have to take it home, and that means you have an extra 2 days of overnight risk because it's Friday. And so this thing's going to gap up or down on Monday, and there's no way to know which way. This is the way I favor. 41.23 would be the next support, but we already hit it once right here, so I think we'll go down through it. And if you want to short it here, 35.66 is my first target, and I'd put almost equal odds that it'll come down here to about $32. There's a big old gap there that defines those levels. And again, it's objective with a short up. But again, you short it today, and if it happens to pop over the weekend, it could gap up and exceed your stop. That's the thing. Stop loss orders are going to get either filled at the open, no matter how high or low a stock gaps. If it's a stop loss order, because they convert into market orders when the stop price is hit or exceeded, and a stop limit order, which says stop me out at let's say $53, but no higher. If I short it, I don't want to be stopped out any higher. That's a stop limit order. But guess what? If it opens at 53.01 and never looks back, your order stands there. The limit price is triggered, but they will not fill, or the stop price is triggered, I mean, because it went above 53. But unless it ticks down and you get a fill at $53, it could open at 53.01, I mean literally, and then run up to 80, and you're still in it with your order sitting there ready to be filled, but only if it comes back. So know the difference of a stop loss and a stop limit, and know that the risks that they can't be completely mitigated when trading a position because of the gaps. And that's one reason I like futures too. You know, you're not going to, other than the time when they shut down, some of them shut down on the weekend, and Friday at the end of the day, and then open back up Sunday night. And then again, if you're worried about that, you can close your position out and not worry about a gap down in the futures. But let's see if there's anything else. Let me pause the video and just check. No, that's it. I said I didn't want it to be a super long video, so let me get this out to you, and we'll pick it up next week. Be interesting to see how the industrials and financials follow through next week, and what tech does, and the dollar, gold, and of course, as always, I'll continue to hunt for trade ideas for you and anything else that stands out. If I see it today, I'll get it out to you. Otherwise, we'll pick this up next week. So have a great weekend.